This is the CRE Weekly Digest by Lightbox, a firm transforming the commercial real estate landscape by connecting every step of the CRE process with comprehensive tools and data. I'm Martha Kocher with Manus Clancy and Diane Crocker. This is a special guest podcast covering the economic impact of the November election. Our guest, David McCarthy, is Managing Director, Head of Legislative Affairs at the CRE Finance Council, known as CREFC, where he leads the organization's advocacy efforts in Washington, D.C. In addition to representing CREFC on Capitol Hill, David supports the overall CREFC government relations effort with policy analysis and strategy. That's a lot of work, David.
You tell me about it. Sometimes it's a lot more work. Sometimes it's a lot less work. It depends on what's going on.
Well, I'm sure you're busy right now, and we've got a lot of ground to cover. So we're going to jump right into it. First, let's start with one of the easy things I think for you to do. Give us a roundup of the risks and gains by candidate. And obviously, economic policy is front and center in this election. So it's important for us to break it down.
Looking at the top of the ticket, Harris and Trump, that determines a lot of the path forward, but it's really beyond that. So I look at the mix of things. If you have a Democratic president or a Republican president, and then the makeup of Congress. And I think the path forward gets very different depending on those scenarios. So that's how I look at everything, and could kind of turn out with any kind of scenario here. You could have split Congress. You could have both houses of the same party with a president of the opposite party. So we're planning for all of those scenarios. And I think there's a lot of risks and rewards kind of no matter who gets in there. But I think the going forward assumption is it's going to be close. We're going to have closely divided congressional majorities, regardless of who's in power. And so Democrats and Republicans are going to have to work together on anything. And the president has the ability to do a lot of things without Congress, maybe less than they used to, but those are also impacts that we look at too. So I'd say kind of the biggest thing we're looking at is tax. That will be very much decided on who's in the White House and those congressional majorities, more so than anything. And then going down from there, looking at housing policies, looking at climate change, looking at banking regulation, those are probably going to be more impacted by the federal government. And the biggest trade-off I can kind of summarize there is like Republicans, you might have lower taxes, but you might have fewer government programs or government spending supporting specific initiatives. And then the inverse might be with Democrats. You might have greater emphasis on federal spending, government programs supporting different initiatives, but you might have a trade-off of higher taxes. So that's the big overview of the risks and opportunities I see, and happy to kind of get into any specific things.
So you listed several things there. You listed taxes and climate, regulatory, and so forth. Among your membership, does one stand out as the most important topic when you go to Capitol Hill to have these conversations?
I think right now it's tax, and that's because certain provisions of the Tax Cuts and Jobs Act from 2017 are expiring next year. And so what we see is, I think is about a $4 trillion fiscal cliff, or whatever you want to call it, where certain individual provisions are going to expire. And so Congress kind of has to act. We saw this similar in the mid-Obama years when some of the Bush tax cuts were expiring, that Congress kind of had to act. Otherwise, people would face a lot of increases in taxes, which, you know, political parties don't really like to do that on average everyday Americans. So that's a reason why we're focused on it, because there is going to be a lot of action on it, whether we want it or not. So that is the biggest one. And then kind of going from there, there are a number of other things that we're focused on, and largely on regulation and, you know, some things around the edges on housing policy. But I do think the tax debate is going to be very live and something that we have to really focus on, because there could be increases on taxes under a Kamala Harris administration, but also under a Trump administration, because there's a lot of proposals getting thrown about, and kind of whatever sticks, we're going to have to live with. And that presents a lot of risk and a lot of opportunity.
We've had a very bifurcated economy when it comes to commercial real estate for the last 2 years. In the residential housing market, prices near all-time highs, the stock market near all-time highs. Yet in the commercial real estate market, it's been a real slog. Hard to refinance. At times, capital's been constrained. Property values are lower. When you go to Capitol Hill, do you get the sense that the people you're meeting with know how hard the last 2 years have been for your constituents and how slow the activity has been and what the pain points have been for the last 30 months or so?
Yes, I say more so than ever. And that's a big part of my job is what I say myth busting on some of that, both in terms of where the pain points are and where they're not. I think members of Congress generally have been pretty focused on commercial real estate. It comes up a lot more than it used to, specifically the risks related to a downturn there. And that, includes impacts on cities and includes impacts on lenders, certainly, which we care about. So yes, because they also see this, right? They see in their districts and their constituencies, vacant office buildings, they see the impacts on various small businesses with a change in kind of the use of office space. So they're aware of it, and we also keep them informed of it. Certainly the data coming from CMBS on delinquencies is incredibly helpful and shows a lot kind of what's happening in, pretty real time. And it's also useful to show kind of like where the distress is and where it isn't. That's also helpful in terms of not having an overcorrection or jumping the gun on any kind of policy prescriptions. Because certainly what we don't want is to cause panic based on some perception or something that somebody says in a hearing, or some lawmaker saying, oh, all these banks are going down because of commercial real estate, because that's not the current case. And I think that especially after the 2023 bank failures, commercial real estate was always kind of in the conversation as the next tier or that next shoe to drop. And I think we were able to kind of move on and beyond of that, because as you'll recall, there were issues at the Silicon Valley banks, kind of absent kind of any sort of bad credit. It was almost kind of the hubbub, the talks surrounding it and the vibes that caused people to kind of pull their money out of those banks. So having a run on banks because of commercial real estate was kind of something big that we were trying to avoid. And I think kind of having constant communication on that was pretty essential.
Martha and Diane, I don't know about you, but I feel like my blood pressure is going down like with every sentence David Mythbuster McCarthy comes out with. I feel like we are in good hands. Right? He's telling the legislators that there's nothing to panic about, which I 100% agree with, keeping them from making bad decisions over their panic. So I don't know. I feel like we've gone for like 90 beats per minute down to about 55. This is feeling pretty good.
Well, that kind of guarded optimism is something I always try to bring. And look, I hear from members who the sky is falling and some who are like, well, we'll get through this. So I hear kind of all the end. And my job is to kind of sift through that, kind of figure out what's going on and communicate that. So I also don't want to be too Pollyanna-ish in terms of, it's not too sunny of a picture, but I think, being realistic. And I think that CREFC, we have a reputation for kind of looking at the data, looking at what's going on and trying to kind of deliver, if policymakers want options, we can tell you what the impact might be on there. We might have some goals that we're trying to accomplish with that, but we're pretty even keel. We try to be transparent with our process. And I think policymakers, lawmakers in particular, value that. And that's certainly the ethos I think our organization brings.
One of the things that we talk a lot about on the pod is just how much is sentiment changing out in the field. And what Manus just said is, look, they've had a rough past couple of years. So it was interesting. We talked about this on the pod last week to see that one thing that CREFC does very well is surveying your board of governors and reporting back to the industry how their sentiments are changing. So it was really interesting for us to see your third quarter survey where the sentiment index rose to 121.1 for the third quarter. And it was an 18% increase from the previous and the highest reading since it was launched in 2017. And we're certainly out there talking to folks, and there's definitely a palpable sense of optimism that we haven't heard in quite a while, probably due largely to what Powell delivered in mid-September. But I wonder, reading that index and the fact that it's been the highest since the index was launched in 2017 kind of left us scratching our heads a little bit, because that means it's higher now than it was even in the market's heyday in 2021. So I wondered if you could comment on that.
I think this is a great tool for kind of like a point in time. And it is supposed to be forward looking too. So I was actually kind of going back and looking at some of the last data in terms of like the year ahead, what it's going to look like. And it actually looked to line up pretty well. I probably need to dig into it a little more or ask my colleague, Raj Idasani, who runs the survey, on some of that more specific. But it looks to kind of forward in terms of predictions, like fairly well in terms of what the coming year is going to bring. And so I think I would take it with that grain of salt. This is our board. Our board shifts and changes over time. You have some people who were there in 2017. You have that now. But I also think it's reflective of what we've been through. And you look at that very, very low peak in fourth quarter 2022, I think it is, where it's at 61. And then kind of coming off of that, the big spike. I know 2023 was a really bad year, especially for CMBS. And so looking forward, it doesn't necessarily mean it's going to be all sunshine and roses, but it's something that we're looking better than it was before. So I think with that grain of salt, and it certainly feels like that too, I think there is a feeling that we've gone through some of the worst of it in terms of origination. I think that that's maybe a different story in terms of some of the distress that's still out there. Well, that's one thing I always caveat that, there are a number of loans that will still need to be worked through, and an interest rate reduction doesn't solve that. But I think it's also reflective of, the Fed is pivoted now. And I think that kind of buoys the optimism that was already kind of running, at least in the CMBS market, where you saw increased volumes, a lot of transactions going through. And that was before rates. And I think the rates might kind of kick that up a notch, but it's all kind of dependent on that forward-looking optimism. So I'd say it's a look ahead. It's not perfect. Humans are not always great at predicting the future, but I do think it's meaningful because, as you can see from that chart, how it goes up and down, we're not afraid to say when we're not feeling great.
A lot of the confidence obviously is hanging on what people think the Fed is going to do in the short and long term. Let me ask you a question. The Trump presidency, in some cases, calls into question what will happen with the Fed. There's been previous conversations that former President Trump has said that he would either eliminate or replace the Fed chair or possibly do something to oversee it a little bit more specifically. Any chance there's a big change there if Trump does win?
I take him at his word on it. I think he's expressed that he's been unhappy in some ways with Powell if he were to win. But we've kind of gone through this before. And also, I think the question is bigger than Trump and Powell. It's do you want to politicize the monetary policy of the United States? And that's certainly a political question and up to kind of Congress and the president to decide. But I think it's even beyond Trump. We saw Elizabeth Warren calling for rate cuts. So this is in some ways a bipartisan effort, and those chickens will come home to roost too. So if you want it one way for certain reasons, you can't really say, well, we can't fire the Federal Reserve governors because that politicizes this. But then if you have the other party saying that, then does that just make it inevitable that this becomes a political process? I would also say that there are plenty of Republicans who are very much not on board with that. And I think at the end of the Trump administration, you had some more kind of partisan nominees to the Federal Reserve Board who didn't make it out of committee and didn't advance in a Republican Senate when they certainly could have because of some of these concerns that they would not be independent. So I think that there is still a lot of political support on there. I think it's been eroded a lot, though. So I think generally the larger question will still remain with us. I don't necessarily think it will come to fruition, at least in the near term. And also, too, the chairman is certainly the most public spokesperson for the FOMC, but they're one component of it. Even the board of governors, that's 7 different folks. Is he going to fire the entire board? That seems unlikely. And while the Supreme Court has definitely given the president more authority to fire certain government officials, that's so far been limited to single heads of executive agencies that are independent, the CFPB, Federal Housing Finance Agency, the FHFA, not these kind of multi-member boards. So does that cross a threshold that the Supreme Court says, okay, well, this is now a different kind of separation of powers issue? I think that would inevitably come up to the Supreme Court with that if it were challenged. And I don't necessarily see that kind of transpiring, because it gets into a lot of questions that might be resolved differently. And frankly, some of these terms will expire, people will resign on their own, so it might not come to that.
Firing 7 people at once, it would be The Apprentice on steroids, right? We'd have to put that on NBC in prime time, right? With some of those sidekicks you used to have, the old guy who was his accountant and so forth. That could be some interesting television. I want to go back to the election and maybe the forthcoming term of Congress and bring up a couple of different things that may touch upon the commercial real estate market. One of your big constituents in CREFC, which for those that don't know, CREFC represents people that lend all the time, the CMBS market, private equity firms, insurance companies, and so forth. We'll let David talk about that a little bit more later. But one of the big talking points for maybe 5 or 6 years has been the growth of private equity in the lending space. And does that segment of the economy need more oversight? Is that a concern of yours? Do you see something like that happening? We go back 12 years, and of course, the lending spectrum changed enormously post GFC. Any chance that that happens in the next couple of years? And are your members concerned about that at all?
To your question on private equity being regulated, that is absolutely a risk. And it's something I bring up to our members. And I think that there is a recognition among many that they could cross into that threshold of being regulated more in some way, shape, or form. And I think we're seeing that emerge as a bipartisan potential. And I'll kind of walk through why I think that. One, I think the growth of private equity, as you talked about in our space and others, is causing lawmakers of both stripes to kind of take a pause here. And I know we'll get into Basel and the bank capital rules later, but that is, a microcosm of this. There's the discussions on Capitol Hill. If you regulate the banks so much, does this push it outside the banking system? And the response to that from some lawmakers and certainly the regulators is not, well, that doesn't mean we don't regulate the banks. Maybe we just need more oversight into these other markets. So that's an attachment point where that could come. I will also say, too, as private equity and non-banks expand into markets, you also have the kind of political blowback. So I'll give one example in terms of housing. There's this perception of large corporate landlords, certainly single family rental housing. There's a number of live proposals that would limit investors' ability to purchase single family housings, because what members of Congress hear from their constituents is, hey, it's really hard to buy a house. Why is this? And then they can blame, corporate entities from snatching up single family homes. Now, there's a lot of layers to that data, and is it really driving a lot of these housing concerns? Putting that aside, it becomes a villain. And on the flip side, with some maybe more conservatives, I think the ESG, sustainability, climate change debate, this so-called woke capital, you see pushback against that, certainly in the Republicans in the House, but also in some states where are ordering divestment from certain, or they're divesting from certain financial institutions because they disagree with some of their environmental and social governance policies. So that's a different way it could be regulated. And certainly large asset managers, I think we're seeing conversations starting about, should those be regulated like banks? It's absolutely a risk. And I think it will come in a swift way through legislation. I think there are ways to do it through regulation. They're just tougher. They're subject to litigation. There's a lot of kind of tripwires there. But if something happens and there's a lot of political blowback, I think you could kind of see swift regulation on something like that, because the Republican Party has changed. I think J.D. Vance is a very kind of good encapsulation of that. He's been very critical of some corporate landlords and corporate kind of interests, and including the financial system, more so than you see kind of a more traditional Republican candidate, and frankly, even more so than Trump in some regards. So it's something I worry about kind of constantly, and regulators are always kind of like looking for an attachment point to kind of fulfill their mission. And as the non-banks kind of enter more into those other areas of finance, I think you'll see more creative solutions for that. And I do think that will be eventually backed up by legislation if there's an overreach, certainly on the part of private equity and private non-bank markets.
One thing that I wanted to ask about while we had your attention was insurance, in the commercial real estate lending world. I think, Hurricane Helene and shortly after that, Hurricane Milton and the devastation that those two extreme storms brought really kind of pushed concerns about property risk as a result of extreme weather events right to the surface. And the industry was already struggling with skyrocketing insurance rates, to the point where some borrowers can't get insurance or they can't afford it, even if it is available. And that's a real challenge for lenders. So I wondered what CREFC's thinking was on the insurance front and where you kind of see that going in the wake of storms that are getting more frequent and getting more extreme.
Yeah, it's certainly a big topic of conversation, certainly in my conversations on the Hill and certainly within CREFC. My colleague, Syra Berkey, who heads our regulatory and sustainability side, has a working group on this. It's something my colleagues at other trade organizations representing borrowers and other owners of commercial real estate are very focused on. And unfortunately, the answer is there is no easy or good solution. Some of it's like, well, the market will recorrect, or maybe we need some government programs. And on the government program side, the federal flood insurance is not exactly a shining beacon of hope there, because it has not been had a long-term reauthorization since I think 2017. It's been kind of short-term extensions. There's bipartisan oppositions to elements of it on both sides. And unfortunately, as these disasters get more frequent or devastating, as we've seen, that kind of brings new folks into the fold, like Florida, Louisiana, New Jersey. In the Senate, those senators have formed kind of a coalition previously to kind of reform the flood insurance program that's very different than what the House has kind of passed. And that's caused the gridlock here because there's sharp disagreements. There's not going to be an easy fix, because on one side, you want more resiliency, you want better kind of like risk pricing, but that could price many of those constituents out of their homes. And on a commercial level, commercial real estate, if it's in the flood maps, they're limited to a $500,000 policy there under the National Flood Insurance Program. So they have to go to the private markets. So sometimes it becomes a compliance headache because that program is close to lapsing with federal funding. But beyond that, the solution is just not clear. I know we talked a little bit about the Terrorism Risk Insurance Act, TRIA, passed in the wake of 9/11. That's kind of been pointed to as a potential similar example. Maybe we could do with disaster and insurance costs, but it's very different. Thankfully, terrorism losses are rare. When they do happen, they could be incredibly expensive, but that program has not been utilized since its inception. That would be very different here. So it's a much more difficult conversation. And I think what our members have talked about is, doing the best they can to incentivize and ensure resiliency. I think that's going to be a big part of the conversation in terms of commercial pricing, making sure that you have faith that your asset can withstand some of these disasters. I think that's going to be a way to kind of lower some of these insurance costs from a market perspective, providing more information and more certainty that your asset's going to be there in a 100-year flood or a 500-year flood or a 1,000-year flood.
I think it'll be interesting to see how this evolves. The Helene storm is so recent that maybe people haven't gotten their arms around it. But in past storms, whether you're talking about New Orleans, New Jersey, Long Island after Sandy and so forth, the loss to lenders was pretty de minimis. Insurance that was in place at these coastal areas worked, and people were able to restore their properties. There wasn't a lot of credit loss associated with this. Maybe at the very low level there was, where mom and pop stores or strip malls didn't have the right insurance in place. But for the big trophy properties, it worked. The inflection point we're at right now is when something gets as far inland as Orlando last year with the last hurricane that hit in Florida before Milton, or Asheville, you're really talking about a different beast. And it does seem like this is the kind of thing that may occupy more of your time in 2025 than it has maybe in the last couple of years.
Yeah, I agree. Like I said, it unfortunately expands that affected constituents And so you have new members and existing members who will be now more attuned to this because they're impacted by the hurricane. So I agree. And look, I think policymakers on both sides are looking for solutions. It's just what those are. It's going to be a slog, and it already is. And what the role of government, what the role of private industry is, where we live, this is all kind of going to be in play now. I think we had a webinar a couple of years ago that really stuck with me with a meteorologist who worked for a reinsurance. And he said, no meteorologist is buying land on the coast. And this was just about sea level rises. This isn't even about the weather impacts. It's just about sea level rises. And that struck me. That's a lot of valuable real estate that's out there that still gets loans on it. That still people lend on, people invest in. And if there's this segment of scientists saying we can't do this, or we're not doing it ourselves, what are the policy implications of that? So it creates a very complex picture, and also, especially when insurance, when you're spreading costs around.
All right, I'm not as relaxed as I was 15 minutes ago.
Well, you brought up insurance, and that's like just no good answers. I also have that same response on housing. There is a silver bullet on that, but it's just not an easy silver bullet to get to.
Well, I'm so glad you brought up housing, because that was going to be the next thing we were going to talk about. I know housing, taxes, bank regulation, those are some of the top three, especially as they impact commercial real estate. Let's take those individually. You did talk about taxes already, so let's talk about housing.
Yeah. So housing is interesting, certainly looking at the candidates' plans, which I think of as kind of a wish list, depending on how they want to enact them, more or less realistic. So, and just to go back a little bit on the tax thing, one reason tax is such in the forefront, and this relates to housing as well, is because, like I said, we're expecting the margins to be pretty narrow. And in the Senate, you need 60 votes to kind of do really anything of consequence, except to confirm nominees and to pass spending legislation. So the Tax Cut and Jobs Act was passed with 50 votes plus one in the Senate, so that bare majority. So if you can attach something to spending, you can accomplish more of that. But you still got to get everybody in line on that. So with that, some of the housing things that we're looking at, certainly anything that touches the tax code in terms of tax credits, in terms of penalties. I think one innovation that the Biden-Harris administration has been proposing, and certainly Harris herself has kind of incorporated into some of her plans, is to use the tax system to enact housing policy. So there's that 5% rent cap that has been flirted about, certainly with the Biden administration, maybe not with Harris, but that would kind of change some of the incentive structure. If you don't agree to a 5% rent cap, you might not be able to access certain tax deductions as a large corporate landlord. So that's one example there. But then also just the funding aspect of it, federal government support for housing. I think that's a pretty critical thing, because the federal government, if you think about it, can't necessarily impact a lot of housing on the state and local level in terms of zoning, in terms of land use, but they can deploy money pretty easily. And they have a lot of money, whether or not it's just printing it or whether or not it's coming from the federal coffers. That aside, they can kind of change policy through that. So I think the funding conversation with housing is pretty big. I would also say, too, that the GSEs, Fannie and Freddie, on the multifamily side, that's certainly an avenue for policy shifts. And I think we've seen the Biden administration take this up with renter protections that are being implemented through the GSEs, Fannie Mae and Freddie Mac. They're pretty narrow, but you could see that go beyond in a Harris administration too, if those entities remain in conservatorship.
David, you anticipated my next question, which is, what are the differences by candidate in terms of the policy regarding the GSEs? I think they weren't really meant to be the dominant multifamily lender, but here we are. I think there's going to be a big political argument around it. I think Trump has been, pretty clear that he would move to exit the GSEs from conservatorship, whereas Harris would probably follow the Biden administration's lead. But it definitely seems like there's a growing sense that the status quo with the agency lenders is not long-term workable. But there are noticeable differences between the candidates on pretty much everything, but especially this.
Yeah, absolutely. And this is one where that Supreme Court decision a couple of years ago, where it said the president can fire the FHFA director this is where the rubber will hit the road on that. I think at any rate, if there's going to be an exit, which I think you're right, Trump has said that he's committed to doing that. That's going to need a willing partner in the Treasury Department and the FHFA. And now that you have the president being able to kind of appoint those two in the same time, I think that will be helpful if that's the goal. And I think Sandra Thompson under the FHFA has done a lot to kind of equip the GSEs to exit conservatorship from a capital and business perspective. Whether or not that Harris administration would pull the trigger on doing that, I think it's unlikely, because I think even in a Trump administration, if that's the end goal, they're going to encounter a lot of opposition from industry folks as well, because the status quo, well, it's kind of odd that they've been in conservatorship for well over a decade. It works in some ways for a lot of people. So I think that is going to be an entrenched interest that's going to be hard to overcome. And I think on the Hill, you don't see that many champions anymore. They might rise up. We might see a new night for a GSE reform champion. I don't necessarily see it coming quickly, but you don't necessarily have that political will to kind of exit conservatorship, because the multifamily thing, obviously, we're focused on, but the single family is driving a lot more of that. I think the multifamily is a little bit easier for folks to get their arms around, and maybe we see a bifurcated approach in terms of focusing on multifamily spinoff rather than single family, but it's somewhat unknown on that. And I think the administrative path forward under the Trump administration is quite likely. Harris, I do think, as I mentioned, I think they found it as a useful policy tool if you can kind of have that federal attachment point. And it's one of the very few areas where I think they have a broad swath of authority where they can move the market through those requirements, whether they're built into the loan agreements or whether it's some sort of regulation. This is one of the few areas where they have kind of unfettered authority to do that via the conservatorship. Once they're out of the conservatorship, that, regulatory oversight is still there, but it's much less effective, in my opinion, and certainly would be challenged. So I think we'll see that happen. But even in a Trump administration, I don't necessarily see that as a quick process, because they're going to need political support on Capitol Hill, even if they don't need them to pass a law to do it.
Well, Diane talked before about how the candidates differ in so many ways. One way that they seem to agree completely is that neither candidate is talking about cutting our annual deficits at all. The commercial real estate market really thrives when rates are stable and low. They have certainly not been low for the last couple of years. Tell us about your membership, and is this something that people talk about a lot, the federal deficit, its impact on rates, and the fact that the government has to come up with a couple $100 billion every month to just keep feeding the trough, is going to keep rates higher for longer?
I speak at a lot of our conferences, and usually about once a year, I get this question in some way, shape, or form about the deficit. So there are folks kind of thinking about it, and that kind of higher for longer rates, the impact on the federal government's balance sheet. It's almost kind of a throwaway response on my end. People don't care about it. We saw that time and time again. There's a bipartisan amnesia when they're in power, that we don't really care about the deficit from a spending standpoint, from a tax standpoint. And, it's unfortunate. And I think that there are some kind of true believers in Congress about the deficit, but the trade-offs there and kind of the willingness to kind of get to the table and negotiate and make tough decisions, I just don't see the political will for that. And you're seeing that in the campaign. Like, nobody's running on, we're going to solve the deficit. It's kind of turned into a giveaway contest on like, well, we're going to do a tax cut for this, we're going to do a credit for that. Like, it's a little bit of the Oprah, everybody gets a car or something like that. So, it's unfortunate. And I do think that it's something that we probably can't tax our way out of. We probably can't cut our way out of, because if you look at the biggest drivers of federal spending, the military, and then social programs, Medicaid, Medicare, Social Security, like those things are almost untouchable in some ways. And so from my perspective, you probably have to look at growth. And I think that's a tough thing to achieve as well. And it also has trade-offs there too. If you think about immigration, which is a bit of a third rail in a lot of ways and has been kind of toxic, certainly in the Republican Party now, immigration growth through that as a potential way out of deficit or lowering inflation. So I don't think people are dealing with it seriously, and they haven't really been forced to. And, I hope we don't have a reckoning, and I don't know kind of if we will, but no, nobody's talking about it, and I don't have a solution either. So if that increased the heart rate again, I apologize.
I've moved to terrified now.
Oh,
The
no.
fact that nobody cares about this as much as I do is a little bit concerning. So, Diane, let me throw it over to you.
Yeah, Manis, let's see what Basel III does to your blood pressure. I wanted to work this into our conversation, David. The proposal now would require banks to hold 9% more in capital in aggregate, down from 19% when it was originally conceived. So obviously, banks are happy with the move in that direction. Harris, under her presidency, we'd expect the capital rules to be finalized in some form, whereas a Trump presidency would likely stall or maybe scrap that proposal altogether. So I wanted to make sure that we carved out a little time here to get your thoughts on Basel III and how what the fate might be under the different presidencies.
Yeah, I agree. And the reasoning for that is if you see a Trump presidency, there's something called the Congressional Review Act, which allows the Congress and the president to repeal kind of recently final regulations. This happened a lot at the beginning of the first Trump administration, where you had a Republican aligned Congress and Trump, they were able to kind of repeal a bunch of stuff because they could get it through the Senate with 50 votes. So I think if Basel III endgame were to be finalized, soon or within a Trump presidency, I think it would be very much subject to this, even if you had some Democratic control of the House or Senate, because there's ways that they can kind of get around the party controls in there to scrap that. And I think that there's been enough bipartisan pushback against these that you could see something like that happen. In the Harris scenario, I don't necessarily see that because I would expect that President Harris would veto anything like that. You still need the president, and you're going to be nowhere near the 2/3 majorities to override that. So I think we're still waiting on the text of that, which is, I think, instructive. The Federal Reserve Vice Chairman Michael Barr kind of came out with his revised proposal in a speech, but we still have not seen the text because the FDIC, under one of the board members, has kind of put the brakes on it. And so I think that we'll still see some of that wrangling. And even in a Harris administration, it could be dialed back up. So I don't think the banking industry, certainly the large banks, are declaring victory on that. It's certainly less bad than it was. And I think from our perspective, there's a very real question of whether more capital at those largest banks is even necessary. And I think that's the banking industry would say that it's not. These institutions are already well capitalized. And also from our perspective on some of the provisions that they're looking to put in there, it would actually, one, drive some of this business out of the large banks. And my argument to policymakers is, look, if you're concerned about real estate exposure at the smallest banks and you're going to levy higher capital charges at the largest banks, where do you expect this to go? If these are institutions that should be there to kind of stand in when they need to, as they did during the regional banking crisis, maybe we don't need to penalize them more, and we need to look at this incentive structure. I always talk about in my meetings with members of Congress the kind of the commercial real estate ecosystem. We have a pie chart showing kind of like where those loans sit. About 50%, 51% of those are on bank balance sheet, but everybody else, as kind of Manis talked about, those are important, and we need all sources there as well. And those change over time, maybe at the margins too, but policymakers have to realize if they make these changes at the largest banks, which are maybe an easier political target, there's going to be downstream effects, and they should be prepared for what those are.
Okay, David, when you're at a cocktail party, are people asking you to project who's going to win, or are they quizzing you on policy questions?
I think it depends on how close or how far we are from the election. So probably more recently, who's going to win? That's the constant thing. But I get my fair share at the policy questions too. And frankly, I like those a little bit more because it's a little bit more specialized, and most people might have opinions on who's going to win, and that's more kind of predicting the future. And as we know, things can change drastically.
And we'll see in a couple of weeks. How can our listeners learn more about CREFC and the organization, David, if they'd like to do that?
Well, they can go online to CREFC.org. We have a lot of resources there. You can find my contact information. They can email me or call me directly, dmccarthy@crefc.org. We represent kind of all forms of lending. So I would encourage anybody to come to one of our events, look at some of our webinars, or just contact us. We're always willing to help. And frankly, the conversations I have with the industry and members really inform me and really allow me to do my job.
And let me vouch for the organization as a whole. Having been to many of these conferences in New York and Miami, terrific get-togethers. You get to meet people from across a wide spectrum of the industry, and CREFC as well does smaller events throughout the year in addition to their annual or semi-annual events in Miami and New York. So great organization, in good hands with David, and it's been a great conversation today.
Thank you. Likewise.
Thank you, David, for joining us today, and thanks to our producer, Josh Bruning. Please join us every week as our Lightbox team shares CRE news and data in context. You can listen on any of your favorite podcast channels and send your comments or questions to podcast@lightboxre.com. Thank you for listening and have a great week.
Let's go.